Everyone says, invest in the S&P 500. However, there are many more similar options to invest in. We're talking about ETFs, and today we'll explain what they are.
An ETF, Exchange Traded Fund, is an investment fund traded on the stock exchange that combines features of mutual funds and stocks. It's designed to track the performance of a specific index, sector, commodity, or other asset. ETFs can be easily bought and sold on the stock exchange, just like stocks.
Simply put, think of an ETF as a shopping basket full of different financial items, such as stocks, bonds, or gold. What's in the basket depends on what the ETF is focused on, like technology companies, a specific index, e.g. S&P 500, or oil prices. When you buy an ETF, you're essentially buying a share of everything in that basket.
ETFs are categorized based on what they focus on. Index ETFs are designed to track the performance of a specific stock index, like the S&P 500 or MSCI World. Their goal is to replicate the performance of the entire market or part of it, making them ideal for broad diversification and low costs. For example, the SPY ETF tracks the S&P 500 index.
Next are sector ETFs, which focus on specific sectors of the economy, like technology, healthcare, or energy. These ETFs allow investors to target industries they believe have strong growth potential. For example, the XLK ETF allows investments in the technology sector in the USA.
Commodity ETFs track the price movements of commodities such as gold, silver, oil, or natural gas. Some of these ETFs directly hold the commodities, while others use futures contracts. This makes them suitable for investors who want to bet on the price movements of raw materials. For example, the GLD ETF tracks the price of gold.
Bond ETFs contain bonds, such as government, corporate, or municipal bonds. These ETFs help diversify a portfolio and generate steady income from interest payments. They're suitable for investors looking for lower risk and stable returns. For example, the AGG ETF tracks the U.S. bond market.
Inverse and leveraged ETFs are a specific type of fund. Inverse ETFs profit from the decline in the value of the underlying asset, making them suitable for speculating on market downturns. Leveraged ETFs, on the other hand, use financial leverage to amplify daily returns or losses, such as 2x or 3x the movement of the underlying asset. For example, SDS is a 2x inverse ETF tracking the S&P 500. These are very risky.
Each of these ETF types has its specific use and is suitable for different investment strategies, from long-term diversification to targeted investments and short-term speculation.
Investing in ETFs has many benefits. Diversification is one of the key advantages. When you buy an ETF, you're automatically investing in a broader range of assets, like stocks, bonds, or commodities. This diversification helps spread risk, because if some of the assets in the ETF lose value, others might rise or remain stable. This makes ETFs an ideal tool for investors who want a well-diversified portfolio without having to buy individual stocks or other assets.
Low costs are another significant advantage of ETFs. Since most ETFs are passively managed and track specific indexes, they tend to have lower fees compared to actively managed funds. While mutual fund fees can be higher due to payments to fund managers and transaction costs, ETFs usually have lower management fees, meaning more of your money stays in the fund. This allows investors to keep a larger portion of their gains.
Liquidity is another key advantage. ETFs are traded on the stock exchange just like stocks, meaning you can buy and sell them anytime during the trading day at the current market price. This offers high flexibility and the ability to respond quickly to market changes, which is especially beneficial for active investors.
ETFs are highly transparent as they regularly publish a list of their underlying assets and their value, often on a daily basis. This allows investors to have a clear overview of their investments and provides detailed information about costs and performance.
Before selecting an ETF, it's important to set clear investment goals. Consider whether you want long-term growth, diversification, or speculation on a specific sector or region.
Carefully analyze the underlying assets that the ETF tracks. Find out what index, sector, or region the ETF represents, and make sure it aligns with your investment goals. It's also important to check how well the ETF tracks the performance of those assets and its historical returns.
Assessing costs is key. Compare the fees of different ETFs, such as expense ratios, which show what percentage of your investment is deducted for fund management. Lower costs generally mean higher returns for the investor.
Over time, make sure to monitor your portfolio regularly to check if it still aligns with your goals. This will help you react quickly to market changes and adjust your investments as needed. In upcoming videos, we'll discuss the 5 most well-known ETFs, the assets they contain, and which regions they operate in. Follow us here and on Instagram so you don't miss anything, and we'll see you in the next video.